beyond banking as well. So that's a bit about RBC Meeting Place. We're so pleased to be here today. So thank you, ACCES Employment, for having us. And now for our main presentation, I'll hand it over to Ray.
Good morning, everyone from East Gwillimbury, who's wearing a beautiful white coat today. My name is Ray Seeger. I'm a mortgage specialist with RBC. It's an absolute pleasure and a thrill to be here with you today. I want to thank ACCES Employment. I want to thank my partners at RBC, and I definitely want to thank you all, the audience, for investing your time and allowing me the opportunity and my partners to share with you some of the things we know, and we know them quite well. So I really appreciate your time. I do understand that there are a lot of or some newcomers with us here today. 27 years ago, I was a newcomer myself, and I'll share a very quick story with you. I actually, about 21 years ago, I was a first-year student at the University of Windsor, and you know, I was going through the changes that a newcomer to Canada would go through. And I had rented, as a student, I had rented this really, really miserable little room in a basement at some rundown bungalow in Windsor that I lived in, which I never really realized how much I love and I appreciate that place. I've always thought I really hated it because it reminded me of the hard changes that I had to adjust to moving into a new country, coming from my home country of Iraq. Funny fate should have it, I showed up to work on Friday, and one of my realtors calls me and says, Ray, here is an MLS for this property that my client is looking to buy. And I take a look at the MLS, and I'm reading the address, and I said, this is in Windsor, isn't it? And he said, yes. I said, this is the very first house that I lived in. So it just made me travel back in all my journey in Canada. And I had to reflect on all the ups and downs and all the changes that I had to adjust to. And I really appreciate what newcomers go through, just because having gone through it. And I'm so happy and thrilled if I can play a very, very small part in building your life here. So I appreciate the opportunity, and thank you very much. Today, I will be talking to you about what you will need to know to buy your first home in Canada. I will cover a few things. One of them, first starting off with, how do we get ready to buy our first home? How do we prepare ourselves? Once we prepare ourselves and we get ready, we need to know how much we can afford, so that we don't extend ourselves too much and buy something within our means. Once we know how much we can afford, not all mortgages are the same. Just like, a car is a car, but there's different types of cars, and each one of them will help you achieve your objective differently. Mortgages are very much the same thing. There are different products, different setups for your credit, different management techniques, and you'll need to know about these things. How do you go about buying your first home? And then once we've bought our home, we've gotten our mortgage, we've chosen what's the right mortgage for us, how do we manage our mortgage, and how do we pay it off sooner so that we're debt free? Next slide, please. So, as I promised you, getting ready to buy your first home. First thing we need to know: are we ready to buy? My family moved in. My parents kept going back and forth back home. For a while, we weren't ready to buy a home. My father at the time didn't really want to buy something when the family is not fully stable. We were not emotionally ready, so we didn't. We waited for a few years. My uncle, on the other hand, the day he landed, the next day he was out and about looking at buying a house for his family. So, it's different from one person to the other. You need to have emotional readiness, because you need to find out whether you are ready to be a homeowner. And we can show you that in 6 easy steps. And we need to know whether we are financially ready. How much can we afford? And especially, in today's dynamic market, prices and the way that, you're going into purchase homes and there's multiple offers, there is multiple bids, and how do we manage through that? We will show you some online tools to help you how to go about the home buying readiness quiz, rent or buy calculator. We will also show you that. We should consider both current and future goals, and how do they match up to our objective of purchasing that home. How much do you need? So one of the things that I always get asked is, how much do I need a down payment to put as a down payment? Realistically, there is no one answer that fits all. Every situation is different. Every client profile, I always say, just like we always have different DNA, financially, every client has different financial DNA as well. So what works for one client may not work for another, or just because somebody else was able to buy a house with 5% doesn't mean that anybody else that wants to buy can go about it. We have to dig down and to the details and see how did they qualify for that and how we go about it. Typically there's two types of mortgages. There's conventional mortgage, which is a down payment of 20% or more of the purchase price, and then you would qualify for the rest of the mortgage, or you can go with a low down payment mortgage, which is also called default insured mortgage, which is less than 20%. The minimum is 5%, but it does have restrictions. So one of the restrictions, for example, the property cannot exceed a certain amount of dollars in terms of price, and then once it exceeds, you have to put a little bit more down payment. And it also, once you put anything less than 20%, you are required to put to purchase what's called default insured mortgage. Next slide, please. So with that said, do I have the down payment or not? So do I buy now or buy later? You have to weigh it out. You have to see what's better for you and your family, or what's matches to your situation better. If you buy now, you might be able to buy with a lower down payment. So for example, if you've already secured employment in Canada, you might be able to buy with a 10% or 5% down payment. You will have to put a mortgage default insurance on it, so that costs a little bit of money, and it is added to the mortgage for your payments, but it is something that is added cost on you, on the cost of borrowing. The benefit is you get to own your own home right away and start building equity. So as you can see, you probably have heard, and I'm sure you have friends and family here, or you've talked to your colleagues, they always say the market keeps going up. So you have to weigh out whether do I buy today with 10% or less than 20% and then let the home raise in price or increase in value, and that way I am earning equity in it, or do I wait off and then maybe I can save a little bit of more money on to put a larger down payment. I don't have to pay the mortgage default insurance that's required if I reach the 20%, and then I may have to buy it at a higher price next year. The other thing is you need to think about and evaluate is, do you continue paying rent, i.e. do you pay somebody else's mortgage for the time being? You need to consider other factors as well. So will your move, when you're buying a home, so will your move be short-term or long-term? Do you know where you want to live? Have you settled down for work? Do you know where the kids are going to school, etc.? Do you want the independence that comes with owning your own home? Of course, everybody wants independence. However, there are costs and things that you need to learn about before you make that jump. Are you confident about your financial situation, job stability? Are you working within the same field that you have experience in, or do you have to requalify? And how long does the requalification process? For example, let's take a family physician who was a doctor back home. They take about 3 years to reevaluate their credentials so that they're able to start working in Canada and earn money. Now, does that match up to their current financial situation? Will they be able to pay that mortgage until they study and they finish their qualification process and get to where they want in their career? So these are things that you have to consider. Is it a good time to buy? but today's market, it's a buyer's market. Yeah, it's a seller's market. I apologize. So basically, there is very limited amount of inventory in the market. There's a lot of buyers, and that's why you keep hearing about bidding wars, where one house goes for sale and then there is 10 people that go and start bidding on it. However, having said that, the prices, if we look at the trend of the prices of homes in Toronto, you could see that they just continue to go up for at least so far. Next slide, please. Sometimes we may not have the down payment that we need to put right away. We may need to work towards it. The best, these guys, our partners from RBC, are really the best people to talk to. And how do you make that plan come true? So you could set up a dedicated saving plan where you take a little bit of your money and put in every month or what have you, and you get to the down payment number that you want to get to. You could use your tax-free saving account. You could use, as a first-time home buyer, you could use your registered retirement saving plan, which is your RRSP. Basically, you borrow it from it, and then you have to return it to it over a period of time, and there is no implications on taking that money out. Gifts from family and friends, I see a lot of that in what we do, to be honest with you. Considering today's price levels, we see, especially for newcomers, we see a lot of gifts to be able to purchase a house. But the good news is we are here for you to make sure that regardless of how you plan on purchasing this house, we make sure that you're doing things the right way, and get you to the number you want to get. Just some key numbers for you. 28% of first-time home buyers do set up a dedicated saving plan. I think this number should be higher, to be honest with you, but these are the numbers that we have. But it is a very, very useful tool for you, and you'd be surprised. I remember I worked with a client for 3 years to save up a down payment. I was out in the Brampton market, and they were newcomers, and the day, they couldn't believe it. 3 years later, when I called them, I said, look, I think by now you have the down payment that you need to purchase the house you want. And that's something, time flies by. So take advantage of these tools that are available to you. 23% of first-time home buyers plan to use their TFSA. Again, tax-free saving accounts are just another vehicle of savings. Ria and Nazneen and all the folks at the newcomers, those are excellent people. These are your friends, and they're on your team to make sure that you get those things. So make sure you leverage it. And really, this partnership, this is where the ACCESS and RBC partnership brings value to you. Is when I first came into Canada, I didn't have access to these things. I didn't know about these things, and I wish I did. Now that I look back at it, so please do take advantage of these opportunities. 18% plan on to use their RRSPs. So a lot of people, they work, they save, they have a registered retirement savings plan, and they do leverage it to add to their down payment sometimes, so that way, they may use it as the down payment itself or a supplement to their down payment, so that they get to that 20% or more and don't have to pay the default insurance. How do we know how much we can afford? We've got our down payment. We know that we have X amount of dollars. This is what we can put as a down payment. Now, how much is the price that we need to go? Just because we have the down payment doesn't mean it opens up our borrowing ability. So we have to take into consideration your household income. This is the main driver. This is where you earn your money so that you pay your debts and you manage your financials. So we'll take into account what the household income is. Some of the household incomes that we can take is, if you're self-employed, we'll probably look at 2 years history. If you're full-time employed, we'll look at 6 months history. We also can take child tax benefit, or Canada Child Benefit, or I think it's called, and we match it to your expenses. We add all those up and we match to your expenses, and those could include mortgages, maintenance. If you're buying a condo, not a freehold property, you need to think about your property taxes, insurance, utilities, service, car payments, loans, credit cards, debts, living expenses. So we take all of those parameters, we input them into formulas, and we see, is this client able, or are you able to take on this mortgage or loan that you're looking to get so that you can buy your home. One of the online tools that you could leverage on the RBC website is How Much Can I Afford calculator. It's a very easy to use. All of our calculators, I highly encourage you to visit the website and just take a look at those, play around with the numbers. It will give you a very clear indication of where you stand. And of course, we are here for you to have the conversation whenever you're ready. And we would love this. This is what I love doing. So if we given the opportunity to speak to you one-on-one, that would be also our pleasure. Next slide, please. So what does it really mean to, what does it really cost to buy a home? We got the mortgage, we got the, we bought the house, you know, we got the mortgage approval, all is good, but are there more cost associated with this? Do we need to budget for it? And the answer is, of course, yes. And there are closing and one-time costs, and there is ongoing costs. So some of the things that you need to think about for a one-time cost is a lawyer. You need a lawyer to register this this mortgage on your property, to finish the papers, make sure everything is right, make sure that you are protected, the bank is protected, everybody that's in this or transaction is doing things the legal way. So there is a lawyer cost that's involved. You need a home inspection where, you know, as you buy the house, you probably, if you've spoken to realtors, they always talk about financing condition and inspection condition. This is where you go and you inspect the home, you inspect the pipes, you inspect the walls to make sure there's been no damages and that you're buying something that you can put your family in, knowing that you know, there's not going to be any issue. Moving costs. Basically, you need a moving company to bring your furniture in, and could be resettlement if you're living in a different city, moving and all that. There is a property survey cost, land transfer tax. Everybody has to pay for that on a purchase. However, if you are a first-time home buyer, your lawyer can help you recoup an incentive that's available to you from the government, so you don't pay as much as somebody who's bought second homes, third homes, and so on, or multiple properties. Title insurance, this is just to make sure that you are liability free in case that something has happened and there is a legal action that's been on the property, registered on the property from previous homeowners. So to make sure that you don't take on that liability, lawyers will do a title insurance to ensure that. GST tax, this is on new homes only if you're buying from builders. Disbursements, this is where the lawyers basically, you know, the fees that the lawyers send the money to the selling lawyer, or, you know, all to give everybody the money that they're looking for, to be honest with you. That's what it is. Utility hookup, usually there is a deposit component that you have to pay for your hydro, your gas, and so on. And these are the things basically that you need to, your phone, your cable, internet, etc. As a rule of thumb, set aside about 4% of the purchase price, and that's what your one costs will be somewhere around. This is just a handsome estimation, to be honest with you. Most of the ones I've seen are 2.5% to about 3%. But, you know, to be on the safe side, if you budget 4% of the purchase price that you're buying, then that should cover your closing costs. You also have to keep in mind your ongoing costs, basically your mortgage payment, your maintenance, if the property does have a maintenance component or condo fee, property taxes. You need to have a home insurance, a homeowner's insurance. Your utilities that we spoke about hooking up for the one-time cost, there is an ongoing cost to them, a monthly bill that you will get. Services like your phone, cable, and internet. And it does, if you look at the bottom, it does talk about eligible first-time homebuyers can claim the first-time homebuyers tax credit of $5,000 and receive up to $750 in federal tax relief. That is done through your lawyer, and they will ensure that you get that discount. Next slide, please. So once we have found a house, once we know that we qualify for a mortgage, we have to pick what the right mortgage is for us. We have some decisions to make. As an expert or a specialist helping you with this, there are decisions that I can advise you on, but I cannot take them on your behalf. I can explain them to you, and then you and your family, you and your spouse or partner, you can decide of what the right thing is for you, depending on your financial comfort levels. So decisions to make on your mortgage: interest rate type. Do we take fixed rate or a variable rate? And the differences between them, I think we will cover them in a later slide. But basically, a fixed rate is something that you will have for the duration of the term. It never changes. You will pay the same amount for the duration of the contract between you and the bank. A variable rate changes with the prime, and we will cover a little bit more. Amortization length: this is the time it will take you from day one you've taken on the mortgage until the last day where the balance is zero. So it goes from 5 to 30 years. It's one thing to keep in mind: if you are paying less than 20% down payment, you are not allowed to go up to 30 years. Maximum you can do is 25 years. The term length: this is the contract that you sign. Basically, I am borrowing, you go to the bank and you say, I am borrowing this money for X amount of years, 5 years, 2 years, 1 year, 3 years, 4 years, and so on. And we will basically have an agreement where I will pay you an interest rate of this much, therefore every month, and this is how much I will be paying you for the duration of this contract. A lot of people sometimes mix up the amortization with the term, and those are two completely different things. The term type: open or closed. Also, we will cover that in a later slide. And payment frequency: monthly, semi-monthly, bi-weekly, weekly, or accelerated bi-weekly or accelerated weekly. This is basically I find a lot of people match them up to their payment or their salary frequency. So if you get paid bi-weekly, they usually do their mortgage payments bi-weekly. If they do monthly, and so on. Next slide, please. This is the slide where we talk about the difference between fixed and variable. Type of interest rate: fixed. It says interest rate stays the same for the term of your mortgage. Basically, never changes. You know exactly every payment, how much of it is gone to interest, how much of it is gone to a principal amount, and for the duration of that contract. A variable rate: interest rate varies with the bank's prime rate. So there is something that's called the prime rate from the Central Bank of Canada. It's highly tied to the bank's prime rate. So basically, where in a fixed rate you would get, this is the number that you'll pay for your interest. So let's say 2.2, and that's what it's going to be. With variable, it's a formula. You will get prime minus a number. So if the prime moves up, then the number would go up, and therefore the cost of borrowing on you would go up. If prime moves down, then you are able to take advantage of that, and the cost of borrowing goes down because your interest, the final interest rate, you're paying down. Some people, what they like to do is they like to combine. So let's say they're borrowing $200,000. $100,000 will be in a fixed component, $100,000 will be in a variable component, and that is called a hybrid rate. Type of the term: open or close. This is where you have an open mortgage. Basically, a mortgage can be paid off in full or in part at any time without a penalty. So, if you have an open mortgage, you go to the bank tomorrow, you've sold a property back home, for example, you've got a chunk of money in, you want to pay it off, and you want to use that money to pay off your mortgage, you can just show up to the bank and say, I want to pay this off with the funds I have in my account, and there will be no penalty. They'll just use it. If it's a closed mortgage, then there is a penalty that may apply for partial payments or payments in full ahead of schedule. So usually it will depend on whether this is a fixed or a variable mortgage, and each one of them there is, if it's a fixed, then you're paying the interest rate differential that's remaining on the term of the contract. If it's a variable mortgage, then all you pay is the 3 months interest, and that's it. You can pay off, and that's the penalty for it. Next slide, please. Amortization term, if you recall, a couple of slides back, I said a lot of people mix those two up. Amortization is the amount of time needed to pay off the mortgage in full. So basically from day one, you've taken it at, a balance of 500,000. How long is it really going to get you to make payments to get to the zero balance? And the term is the length of time you agree to a specific interest rate and payment amount. Typically, the most popular ones are 1 to 5 years. Next question. Next slide, please. Sorry. So now that we've learned what the mortgage skeleton would be like, how do we go about finding what the right house for us? What do we do? Practically, we need a mortgage pre-approval. I spoke a little bit about conditions and when you're putting an offer on a house. There's something called the mortgage pre-approval, and the nice thing about RBC that stands us out pack, our pre-approvals are firm, basically, and that's not because we're so special. RBC's process, we take all your documents up front, where we review everything. We make sure that you qualify for the amount of mortgage that you're looking for, and you can afford to buy this. And once we come back and tell you, okay, this is what you can afford, this is what you can buy, and this is what you've been approved for, you can actually go in and knowing that the bank will stand behind me. At that time, you can make a decision with your realtor whether you want to go in with a financing condition or not. Of course, you have to assume the risk of doing that, but from our side, if we pre-approve you, that means we will stand behind you on the house, providing that the house does fit our lending criteria. So there is still a component where we have to appraise the house and make sure that it's habitable, but at least that the mortgage, if all is good, then the mortgage is not a problem. So in a multiple bid environment or in a bidding war like the market we're in right now, I see the pre-approvals come in very, very handy. It just gives you an extra tool when you're buying the house or the property to go in and make sure that you are able to compete with the other buyers. Another benefit, of course, is knowing ahead of time how much you can borrow. And also, one of the important things is that we are able to guarantee the rate for you for 120 days. So let's say, you're ready to buy a home, but you haven't found the right one yet, but you want to make sure that you take advantage of the low rate environment, and you want to book that rate in case it goes up. We can do that for you, and we can reserve that rate for you for 120 days just by doing a pre-approval. What does the bank take into consideration when we're doing a mortgage pre-approval? Basically, your income, your net worth, available funds, credit rating, and the source of those available funds we have to look at as well. Documents to bring to the first meeting with your mortgage specialist. Again, depending on your situation, some documents I may need from one client, I may not need from another client, but in a nutshell, we want to make sure that it's your pay slip. We want to see your earning capacity, last year's tax return showing your income, and your saving and investment account statement. So basically, that will give us a very good indication of how much you earn every year or what your income is every year and what's your financial and saving ability like. Of course, there are special programs that go for newcomers. As a newcomer, sometimes you come into the country and it's going to take you a while to stand up on your feet. So there are equity programs where you may have to pay a little bit of a higher down payment, but it also allows you, as long as you have some savings. So I'll tell you very briefly about our newcomer equity program. You pay down 35%. You have 1 year of mortgage payments and property tax and a proof of what your earning capacity will be. And even if you haven't started work yet in Canada, we can actually qualify you based on your projected income. Another example, if you already started working in Canada, we don't look at the credit rating because you're too new to have established a credit report. So, but you are employed, you do get with that, you can take advantage of paying 20% only as a down payment. So there are different programs, there are different vehicles to get you to where you want. Therefore, I do encourage you, if you are playing with the idea of home ownership, or if you're just bouncing it off your head, talk to an expert. We will be there. We will provide you solutions. Next slide, please. Of course, nobody can do this on their own. You need, if you are buying a home, and especially for the first time, you do need a team of professionals that will work with you and basically form the circle around you to make sure that your interest is protected and that your goals are achieved. And I'll go through some of them and tell you what each one of them can do. An RBC mortgage specialist, so somebody like myself, I can look at your financial situation, and I can learn more about your dreams and goals, and I can give you an expert financial advice. We do offer competitive rates. We are one of the biggest banks in Canada, so obviously we have been doing things right. We do help you get pre-approved so that you can shop with confidence in this market environment. Advice on mortgage life and disability insurance. So this is something that's very important that a lot of people miss is, I earn this much, therefore I can afford this much today. But this is life. What happens if life takes a turn on my family? What if I'm no longer there and able to work? What solutions or what access do I have to solve that problem? This is something we can help you plan for and make sure that you're protected. And of course, referrals to other professionals. I like to think us mortgage specialists, we are the center of the world of real estate. We know people in renovation, we know contractors, we know realtors, we know lawyers, we know inspectors. So pretty much anybody that you need in this process, we are able to help you find and connect you with the right people. A real estate professional helping you set the right price for your home. So this is a case where you're looking to sell or buy. We all work as a team to set that expectation. They basically, if you're selling a home, they do the marketing and showing your home and set it up for the sale. They show you potential homes to buy, which area to buy in, and they represent you in the negotiations. So basically, they make sure that a lot of people sometimes they say, I don't need to use a realtor. True, you don't need to. You could do house sales privately, but having a professional that oversees the process makes sure that your interest is protected. Home inspector, we spoke about that. Somebody who goes and makes sure that there are no deficiencies or they evaluate the problems or potential problems in the home. And the lawyer, they review all contracts, protect your legal interest, and ensure closing documents are complete and delivered on time. Basically, those four professionals help you get the key at the end of the transaction. Next slide, please. Now we've got our house, we've got our mortgage. Now we have to figure out, how do we pay this mortgage that we borrowed? So we borrow hundreds of thousands of dollars, sometimes over $1 million. So let's see how we can pay it off quickly so that we can be debt free. Online banking with RBC makes it very easy. So you are able to view your mortgage account details, and you can take advantage of the flexible options. Basically, when you take a mortgage, I always say, a mortgage product from RBC is like you're buying the Rolls Royce of mortgages, except you're pretty much getting it at a very competitive price, because you are able. Every mortgage comes with a skip a payment option. So we're in Christmas right now. Let's say you've racked up a lot of gifts and bought a lot of gifts for your friends and family for Christmas. You're a little bit short on cash. You pick up the phone and you tell RBC, can I skip this payment and pay at a later date? They'll let you do that. You can double up your payment. So instead of, let's say your monthly payments is $1,000, you can make it $2,000. And what that will do is that extra $1,000 is going towards the principal. And because you're paying more on towards the principal, you're decreasing increasing the time you're borrowing that money, and as such, your cost of borrowing is going down. So you're paying less. And you could also make extra payments towards your principal. So you can take advantage of your lump sum payments every year between anniversaries. You can make 10% of the principal amount you borrowed, and that all goes interest without any interest towards the actual principal payments. Next slide, please. These are the flexible payment options. Basically, you can increase the payments and be mortgage free sooner, pay more frequently, switch from monthly to accelerated weekly or bi-weekly. Basically, bi-weekly, there are 26 payments. I think with accelerated bi-weekly payments, you would pay 28 times. Double up payments, increase your regular payment by up to 100%. So you don't really have, if you're going back to my example, if you're paying $1,000 every month, you can go to $2,000, but you don't have to. You can pull whatever is comfortable for you. Prepay a lump sum. This is the payment between the two anniversary. You've got a lump sum or some savings. You were able to manage to save up 10% of the original amount you borrowed. You can just show up and thus apply to the principal amount. You could decrease payments and increase your cash flow. So you can skip a payment once a year, and you can always lengthen the amortization. When you stretch the time that you're borrowing the money for, the regular payments go down, but because you're taking it for a longer period of time, your cost of borrowing may go up. So what you could do is, you took on a 30-year amortization mortgage. 5 years later, you're at 25, you still want to reduce your payment. You go back and you restretch it again to 30 years, and that will bring your payment down. Next slide, please. This is a sample mortgage scenario of everything we spoke about just now, of how to save on interest. Let's assume you take on a mortgage for $150,000. If the interest rate is 4.5, amortization 25 years, increase your prepayment options. You have increased your monthly payments by $20 only. If you increase that, or your regular payment by $20, the interest cost and savings is $4,756. And if your amortization is 30 years, you've reduced it to 29 years just by adding $20 every month. Make a double payment of $830 once a year. You would save about $15,251. You would reduce amortization by almost 3 years. You could switch from monthly payment to accelerated weekly. Again, the saving on that, $15,743, almost 3 years in amortization, and so on. With the last one, prepay $5,000 once every year for your lump sum payment, and that will save you in interest about $51,730 in about 12 years. So these are the things we've covered today. I'm sure that you have some questions. I'm more than happy. I am being told that we have very limited time. So I'm very happy to answer any questions. And of course, I'm available even after this if you want to reach out on the information there displayed in front of you, and I'll be more than happy to answer any questions.
Awesome. Thank you so much, Ray, for the great, very, very amazing and great presentation. So I took lots of notes. Anytime you present, I learn something new. And thank you so much for sharing your story, about your very first place that you lived in Windsor, and how by seeing the MLS, you have flashback to the, those, the first days. I'm sure as a newcomer, you also went through so many challenges. So like all of us, basically. And that's why actually we are here today, right? So I'm sure that you helped so many newcomers by providing those great tips. And I'm so glad that you, talk about the importance of pre-approval, how RBC can reserve like 120 days that they can take advantage of the current low rates. So much. Thank you so much again. So let's get to the questions. I see that so many questions coming in. So let's start with the first one from Calindia. So Calindia would like to know that after she bought a new home and got the mortgage, so after 3 years, so decided to sell and buy a new home. What happens to the current mortgage? Does it convert to the new home, or is it the new buyer going to take it?
Thank you for the question. Sorry, did Quinn want to take that? Okay. Thank you for the question. It's a great question. Actually, you have the option with RBC, as long as you qualify, you can port the mortgage to the new home. So basically, you don't have to break that mortgage if you know, sell your house and you're buying a house and it's within 90 days, you can take that and move it to the new house without paying penalty. And that's called portable mortgage. So it stays with you. The new owner does not take over the new mortgage. However, some people like to break it or take advantage of rates if it makes sense, if it's going to save them money. So some people decide, no, I'll break it and I'll get a new mortgage altogether. Of course, it has to make financial sense, but the chances are, the fact is, it is a flexible product, so you are able to take it and put it on the new home.
Perfect. Sounds great. Thank you so much. So the other two questions is about the fixed and variable rate. I know that you already covered about it, but there's another question about the fixed rate. So Kalinda would like to know, like, what's the base way for the interest rate? Like, is it a fixed one? A fixed one for a number of years, or variable rate? And can you change the interest rate if it's fixed in the market? Like, let's say if there's a better rate in the market, and also as well as the variable interest rate. So if you can let us know that, what is your opinion with regard to variable interest rate type, and what is the current rate for variable rates?
So we always get this question, is what do you think? Should I go variable or should I go fixed? And the answer is, nobody has a crystal ball to be able to predict what will happen in the interest rate environment over time. I have clients that in 2017, for example, we thought, there were talks about interest rates flying so high. 5-year rate was at about 3.99 from the bank. And everybody thought it would still be going up. So a lot of people, when they bought, they fixed their rates. I am one of those people for one of my properties. I actually have, until today, I have a property that I pay 3.5% on. And I left it like that, because what happens is, if I decide to break it after the rate has gone down, if it's a fixed component, there is an interest rate differential prepayment penalty that I would have to pay. Now, once I find out what that number is, and it could get, hefty, once I find out what that number is, I can decide whether it makes financial sense for me to do it or not. So, just because, the rate has gone down, it does, and I have a high rate, it's not always in my best interest to break that fix, pay a penalty on it today, just so I can reduce my payment by a certain amount, because what I end up paying in the long run maybe even cost me more. So if you are on a fixed rate, yes, you can, but there will be costs associated with that to switch to a variable rate. If you ever want to break a variable rate, and let's say you want to switch a financial institution or go to a different lender, for whatever reason, then for a variable rate, the prepayment penalty is 3 months interest only. Therefore, I cannot tell you whether to go with this or that. What I can tell you is explain both of them and how they work, and then tell you all the information that I can tell you at the time, and you will have to decide what's right for you. Some people say, you know what, I'd rather my payments be, I want to know exactly how much in interest I pay every month, and I want to know exactly how much in principal I pay every month, and I don't want it to increase or decrease. So that's somebody who should go for a fixed rate. If it's somebody that wants to say, no, you know what, I have some cushion, I can afford even if it goes up, but I think it's going to go down, so I want to take the chance, then you go with a variable rate.
Awesome. Thank you so much, Ray, for answering those questions in details. So the next question from the Elena. This is actually another great question. So, can I be qualified as a new commerce if I've been living in Canada for 2 years, living with working visa, but I've been living with PR status only for 2 months?
Yes. So as long as you have a PR status, you are able to qualify based on our newcomer program. Of course, we would, depending on how much down payment you would use, we would qualify you based on which, different programs. So if your current income is enough to qualify you for the mortgage you're looking for, then we could do this deal at 20% or even less. If it's something where you're practicing, you're in some sort of type of profession where your earning potential will go up over time, as long as it's been 5 years from the time you got your PR, you are still considered a newcomer as per RBC lending policies. So we could use your projected income, not only today's income. Short answer to your question is yes, you can qualify.
Perfect.
Thank you so much, Ray. I'll take over for Naz if that's okay. There's a question here. Is a cosigner mandatory, family or friend? How might a new homeowner avoid the need for a cosigner? What is an alternative option for a cosigner?
So a cosigner can, a lot of people sometimes mix the term cosigner with a co-applicant on a mortgage. A cosigner is somebody where you have a shortfall in your credit. You have gone through some challenges with your credit. It's brought down your credit, scored below the bank's requirement. This is where a cosigner with a very good credit history can come on the application and help you. To avoid that, make sure you manage your credit well. A co-applicant is different, where your income is not enough to qualify for the mortgage you're looking. So this is where a co-applicant would jump in on the application. They have their own income, and that way we're able to use both incomes to qualify you for the new mortgage. But to avoid it, it's not something that's needed all the time, and it's not something that's avoided all the time. It really depends from one situation to the next. And we also have, even if you have credit issues, we also have our AMS program where we work with different types of lenders. We work with over 20 lenders, private lenders. If there is a problem with your credit, we will put you with one of those lenders for a short period of time, 1 year, 2 years, and enable you to buy that home and work with you to resolve the problems with your credit and bring you back once those problems have been resolved. So we always have options for you.
Thank you so much, Ray. I have a really good question, and someone, Emra, wanted to say thank you, very useful information, but they have a quick question. Is it possible to switch from variable to fixed mortgage and vice versa at any time? Are there any charges for switching?
Yes. So you are able to switch at any time, but there are charges associated. Associated if you're going from variable to fixed, you may have to pay 3 months interest just to break the variable contract. But if you're going from fixed to variable, this is where it may get very expensive, where you would have to pay an interest rate differential. So whatever interest is left that you haven't paid on the term, you probably will be charged for it. So you have to be careful. I think we spoke a little bit about this, but I'm happy to take this question and answer it privately at any time you like. But if there are charges, and it's different from one mortgage to the next because there are different parameters that go into the calculations.
Nice. Thank you so much, Ray. I have a really good one here. If our bank tells us that the max amount we can get is 400,000, is it likely that another bank can probably give us 600,000? I guess they want to know the parameters, like what it takes to tell you how much you can afford.
So guidelines are guidelines at the end of the day. If we're using conventional formulas to qualify you for the mortgage, then it's the same formula where no matter where you go, and it's the same guidelines for all the banks. So everybody has to play by the same rules. Now, we as RBC have what's called equity programs, where we can, if you get to a certain level of a down payment, we can actually qualify you in non-conventional ways to the mortgage that you're looking. For example, the newcomer equity program that I spoke to you, where you put 35%, you have 1 year of payments. We will work with you based on your earning potential in the next few years, not on what you're earning today. So RBC is, I could safely tell you, and not because I work for RBC, and of course I would be biased, but it truly is the most versatile type of program offering that can give you the solutions that you're looking for. But if you are doing it conventionally, there is no way that one bank will tell you 400 and another bank tells you 600. Something was missed in those lines.
Okay. Thanks so much, Ray. There's a really great question here, and I wanted to get this one in. Do you finance real estate purchases in the U.S., for example, a vacation home or a property home in Florida? If so, does the down payment requirement increase based on the purpose of the property, example, investment property or primary dwelling? So that's a great question.
Absolutely. So yes, we do offer Canadians an option to finance homes, to purchase homes in the U.S. Ria, Nazanin, and their team can put you in touch. I don't do the U.S. mortgages myself, even though I would have loved to. But we have excellent partners in our U.S. RBC folks that can finance your U.S. purchases from here. Of course, there are different terms and conditions depending on where you're buying and what you're buying, but I'm sure they'll be more than happy to go through all the full details with you.
And on that note, yeah, we do have that option available. Thanks, Ray. Great answer and great question. So if you are interested in buying in the U.S., please reach out to Ray. He can refer you to our team at the U.S. Mortgages, and we can certainly help you with that process as well.
Great. Thank you so much, Ray. There's one great question, and I guess it speaks volumes about your presentation today, but they want to know if your service is free and how much do you charge?
our services is free per se. However, if you do take a mortgage from RBC, there is a $300 admin fee for the application once you've taken on the mortgage. However, our time, we are dedicated for you. We get paid by RBC only if you do take the mortgage from us. You don't have to pay us anything. So basically it looks like it's free to you in terms of our service. We are here with you from A to Z. You have questions for us. Usually mortgage specialists, we're known to work around the clock. My information, that number there is my cell phone number. I am reachable, however, by most of the means that the communication apps that you have. You can call me, you can email me, you can text me, and I'm more than happy to walk with you through this journey.
And it's a great question, but something I wanted to add here, and why it's essential to when you're looking for purchases, and these are fantastic questions, by the way. But the reason why you want to go through a person like Ray for this kind of transaction is, one, it's the biggest, if not, it will be the biggest investment you make in your life is purchasing a home. But where Ray can really add, like I said, you mentioned a small $300 cost, but where Ray's expertise lies is his partnerships as well. So partnerships with realtors, his partnerships with accountants, his partnerships with everybody as part of this process, in helping guide you to a successful purchase, right? Because we need to have everybody as part of, this isn't just going up to a house and making an offer. We need to know the agent. We need to understand the area, and the price of the homes is that in conjunction with the market, right? So that's where I think Ray comes in real handy for buyers, and that's why you want to use him for purchases, because of his partnerships that he has within the industry that can help you with a lot of these inquiries as well too. But lawyers, realtors, Ray has connections with all of them.
That's a great point, Quinn, and I could not have said it better, because yes, a mortgage is your biggest credit product in Canada, and it's great to have someone like Ray on your side, and I can attest to his capabilities and his knowledge, because my couple clients that I've sent over, they just rave about him. So thank you, Ray, for this presentation. Thank you for sharing your knowledge with us and our attendees. We have so many more questions. However, if you guys can connect with him directly, he can get those questions answered. And now I'll actually like to hand it over to Amy just for the wrap up.
Thank you very much, everybody. What a wonderful session that was. And you can tell just how important this topic is to so many of our clients. And thank you, everybody, for your attention. If you did have to leave, don't worry. You're going to be getting a recording in your email tomorrow. And I just wanted to, once again, thank our presenters so much for coming today and sharing their knowledge with us. We really appreciate it. We love having feedback. So let us know how you like this and what other sessions you might want to have in the future. We've got an upcoming webinar in December and lots on our calendar, so don't hesitate to review what's available. And we also have lots of resources on anything job search related, as well as all of our YouTube videos where we share these wonderful sessions with our RBC colleagues. Sorry with that. And thank you, everybody, for attending. Looking forward to our next session together and wishing you all a lovely day.
Thank you very much.
Thank you.
Kathleen. Thank you, Ray.
Have a great day.
Thank you, Quinn.
Thank you, everybody. Have a great day.
Thank you, Queen and Ray.